So what's been up in the market? Well, a lot. Over the last 18 months or so, AI has shifted from being a tech sector story to a macro driver, full stop. Trillions of dollars have been reallocated across equities, venture, infrastructure, and even sovereign policy. In 2025, I think close to about $1.5 trillion was invested within global AI as a category. And in the US, it accounted for almost half of US GDP. Since about 2023 or so, when ChatGPT first launched, about $27 trillion of market cap has been created in the US stock market. And so I think what we're seeing is every single major asset class is now responding to this gravitational pull that is AI. And so, despite tariff tantrums, multiple geopolitical shocks, strikes in Venezuela, interest rate uncertainty, and even criminal investigations into the Fed, the stock market has overall been very resilient. AI has effectively become the business cycle. But while the overall AI tide is still rising, not everybody is floating with it. The most apparent is actually publicly traded software companies who, as a group, has lagged pretty well all of the major indices. And then when you double click into the public software landscape today, what you see is effectively two camps. On the one side, you've got the AI haves, and these are companies who can quantify how much AI is actually driving revenue or margin expansion. And these companies have pretty well stayed the same as they were before COVID, so they're in line with pre-COVID levels. Investors in these companies, they're paying for proof, they're not paying for narratives anymore. On the other side of it, we've got these AI have-nots. And so these are more traditional SaaS 1.0 type companies that talk about AI, but can't really show it in the numbers yet, or even worse, show it in the numbers in a negative way. And for these companies, the multiples have compressed to decade-long lows. When it comes to the AI haves, there's really three levels to it. The first is productivity gains. So these are the companies who have been able to re-architect their organizations to really leverage the benefits of AI. Shopify is just but one example of this. At Shopify, before you can bring on a new FTE or hire somebody new, you've got to prove you can't solve the workflow with AI. The second level to it is whether or not AI is a tailwind or a headwind to the core business. Cloudflare is just one example of this. Their core business allows inference to happen at the edge, and so they've just benefited naturally as more and more inference demand is being triggered by everybody using ChatGPT, for instance. And then the third sort of level to it is how well companies are leveraging their core differentiators to launch moonshots and expand the TAM opportunity considerably. And so the example that we're flagging here is a company called Palantir, who launched this product called their AI platform, AIP for short, a couple of years ago, and has seen that revenue trajectory 3x over that period. These companies are getting premium multiples because AI isn't just being talked about on earnings calls, it's actually embedded in their P&L. On the flip side of that coin, the AI have-nots are the ones showing flat or negative AI impact. And these companies are being derated by public markets. Publicly traded SaaS companies as a group are showing negative 30% year-over-year declines in net new ARR. And they're seeing, depending on which quarter you look at, CAC paybacks, or the customer acquisition payback periods, approaching 40 months. Why? Well, there's a couple of reasons for it. One is the view that AI is eroding long-standing product or technical moats. Features that once differentiated products are now becoming increasingly commoditized by vibe coding tools and other tools that allow engineering talent to build faster and more technologically advanced products. The second is that AI is really disrupting distribution. A lot of software companies, a lot of fast-growing ones, relied on this PLG motion, which is product-led growth, where customers discover your product online through search or content channels, get onto free trials, love it, and continue to buy. Well, search and content channels are now completely being disrupted as more and more searches and questions are being are being addressed by LLMs who answer these queries more directly. And so what investors are doing is they're saying, hey, look, if AI can reproduce your workflow and intercept the top of your funnel, the market is effectively assuming that it will, and the valuation multiples now reflect that risk. And so the market's making it very clear that AI is no longer just a narrative premium. It's becoming a valuation filter if you can prove it in the numbers. So that's the public markets. Maybe we'll shift gears now and talk about what's happening in the private markets. Here, what we're seeing is an unprecedented concentration of private capital into a handful of companies. So these are companies that are building models, they're building inference platforms, and data infrastructure. So that example of that would be a company like Databricks. Taken together, these are kind of the foundational technologies that enable reasoning at scale. There's been over $260 billion of AI-related private capital funding deployed into the sector in 2025. And it's not stopping. We're seeing trends in year to date that suggest that more of the same will continue to take place going into 2026. And so what's been happening is that private capital has been actively funding all of this intelligence that's going to be necessary to power this next generation of applications that everybody is super excited about. And so what's the money done? What's all these billions and billions of dollars done? Well, it's allowed foundational models to evolve from prediction engines, which guess which words are coming up next, into reasoning systems, which then allows longer and more reliable chains of thought and action. Models are now in a place where they can complete task lengths of up to about 2 hours. And this has been doubling every 7 months. So this is effectively a model that can continue to work autonomously for 2 hours. There's still a whole bunch of stuff to work out. We're not quite perfect yet. But we're not that far from having autonomous models that can work full 8 to 12-hour days. And so this has really opened the door for this new class of applications in AI agents that can not only respond to a question, but also plan and execute workflows completely autonomously. And these new capabilities are already showing up in the data, especially in how fast some of these applications that are being built on top of foundational models are scaling in terms of revenue. every major model leap has produced this new crop of breakout applications, and the growth curves are pretty staggering. You look at companies like a Cursor or a Lovable or a Glean or a Harvey, and these companies, have crossed $100 million in ARR in less than 3 years. In the case of Cursor, they're over $1 billion now. Lovable is over 200. This contrasts pretty well to what it took premier SaaS companies um, in the last couple of decades or so, where it took about 9+ years for a SaaS company to cross that sort of $100 million threshold. These AI native application businesses, again, doing it in less than 3 years. And so these parabolic revenue curves, underpinned by a lot of this growth efficiency that we're seeing, is driving really accelerated fundraising at the application layer. We talked about how much money was going into the model and infrastructure layer. Well, the application layer is starting to catch up. We're now seeing valuations in the 20 times to 100 times annual recurring revenue for companies that are already at scale. The other thing that is fairly interesting to highlight in what we're seeing in the market is that the timelines between rounds have actually collapsed. And category winners or perceived category winners are raising multiple rounds within a 1 year time frame at valuation step ups of 2 to 3x between each round. Some companies are skipping rounds altogether and just going from seed to unicorn. And so with the public markets really rewarding proof of AI, and the private markets continuing to fund these high velocity AI companies at an unprecedented pace, big question is, how long can this possibly keep going for? How much capital is going to be available to continue funding these rounds? The short answer is, we think there's going to be a lot more to come in 2026. For the last 2 years or so, the exit window has effectively been shut, which means that cash hasn't been being returned to the limited partners in a lot of the venture and private capital funds. And so these funds had trouble raising and then deploying capital. This is all starting to change because of the bull market rally that AI has ignited. And when investors see that kind of value creation at the velocity that they're seeing, it really resets the appetite for risk. And that is a big part of what is reopening the window. The mindset has really flipped from capital preservation to opportunity capture. And so for the first time in a while, bankers over here in technology investment banking at CIBC, we're actually running multiple process again and not just pitching for business. And with that, I am going to pass it over to Joe to talk through what he's seeing in the venture debt market.
Yeah, so in my experience in 30 years of tech, most of it on the equity side, I've never really seen a market quite like this. The numbers dominated by, many companies at the bottom and so few companies at the top driving so much of the economics. I think the slide on the left is really just an echo of what Daniel said. Remember, these are Canadian only numbers. But they really show, I think, the reliance on debt over the last, 5 or 6 quarters as really the most strategic way for a non-AI based company to fund themselves. I think that the equity markets were a little bit slower, constrained by lack of exits. And I think companies that could raise debt did raise debt, or companies that could draw down their existing package did. There was tons of good companies out there, very bankable, that went to the private debt markets or the banks and, drew down unprecedented amounts of debt. It slowed down. You can see there in Q3 2025. I don't know if that's a one-time dip or whether that's the sign of, as Daniel points out, maybe the equity market's opening up again on the back of, some liquidity provided by the AI companies, but we'll see. On the right side, the takeaway from that is, as always, most of the capital goes to Ontario. But BC's still, kicking pretty much bigger than their weight there. They're the darker red piece. And so you'll see that they've raised more than their share of debt capital, and they've done more than their share of deals. It's still a pretty small sample size. It's just Q3. But anyways, yeah, it's a weird time in the markets. It's more important than ever to watch what the strategics are doing. Like in my day, they used to be the buyers, and now they're core to the technology development. It's core to understand what they're doing and who they're backing and who their partnerships are with. And I guess the other perspective I had just hammered home to me this weekend was my best friend works for Databricks, and he was up. He and I spent 4 days skiing from Saturday to Tuesday, just a couple of days ago, and their ARR run rate just exceeded 4.3 billion. I think was the last number they published, which is many times more than BC on the whole in the entire tech ecosystem. It just drives home what the behavior at the top does in terms of driving the numbers, and and really the numbers we're seeing are really a knock-on effect to what the big companies are doing right now.